What if I told you there is a company that just reported its best first quarter operational numbers since 2019, pulled in over $1 billion in revenue, beat analyst expectations by 9%, and posted its highest adjusted EBITDA for a first quarter in 7 full years, and the stock is still sitting nearly 60% lower than it was just 12 months ago? Welcome back to Smart Stock Sam, the channel where we cut through the noise, follow the data, and find the real story behind the ticker. I'm Sam, and today we are going deep on AMC Entertainment's second quarter 2026 outlook, because what is happening with this stock right now is one of the most jaw-dropping disconnects between a company's actual business and its market price. We are going to talk about the billion-dollar revenue story that Wall Street seems to be ignoring, the short squeeze pressure building quietly underneath the surface, the options wall sitting at $1 that tells us something very important about where the floor might be, and the key price levels you need to watch for the week of May 18th through the 22nd. We are also going to look at the 2 structural metrics that will determine whether this is a genuine recovery or just a temporary bounce before another leg down. By the end of this video, you will have a complete picture of the bull case, the bear case, and 2 specific trade setups depending on your risk appetite. So let's get into it. To understand where we are right now, we have to start with the strategic inflection point this company just hit. AMC pulled in $1.05 billion in revenue for the first quarter of 2026. That is not a company in free fall. That is a company finding its footing. Their adjusted EBITDA hit a 7-year high for a first quarter. People are spending more money per visit than ever before, and the concession business, the popcorn, the drinks, the premium food offerings, is absolutely outperforming expectations. The fundamentals on paper paint a picture of a business that is stabilizing and potentially beginning a real structural recovery. So then why, and this is the question that should be keeping every AMC investor up at night, why is the stock sitting at $1.28? That is a 56% decline year over year. That is a price that suggests the market sees a struggling, broken company, not the one we just described. The answer lies in the fact that sentiment right now is completely fractured. You have retail investors who are deeply committed to a 2026 blockbuster supercycle thesis, betting that a wave of massive film releases will drive explosive attendance numbers. And on the other side, you have institutional players who are still staring at that crushing debt load on the balance sheet and asking the question, can this company actually sustain profitability long enough for any of this revenue growth to matter? That gap in perception is the core tension driving everything we are going to talk about today. And before we go any further, there is one hidden metric buried inside the most recent earnings report that completely changes the way the market is currently pricing these shares, and we will get to it. If we dig deeper into the actual numbers from the most recent earnings release, we start to see exactly where the gears are grinding. On one side of the ledger, nearly everything is moving in the right direction. Per-patron spending is at record levels. Concession margins are holding strong, which matters enormously because that high-margin food and beverage revenue is increasingly the engine that drives free cash flow for a theatrical exhibitor. AMC also cleared a meaningful reputational hurdle this quarter by settling the Reverend Barber civil rights lawsuit, removing an overhang that had been quietly weighing on institutional perception. These are genuine operational wins. But here is where the equity story gets painful. The company missed on adjusted earnings per share, coming in at -36 against a market expectation of -34. That 2-cent miss sounds small, but in a stock with this much sentiment riding on it, any miss amplifies fear. And then on May 12th, AMC announced it was issuing 12.4 million new shares to pay down debt. Here is the brutal reality of what that means for shareholders. Every single new share issued makes your existing shares worth a smaller fraction of the total company. It is the classic catch-22 that has haunted AMC's equity story for years. They need to issue shares to manage the debt load, but issuing shares destroys the price discovery that would otherwise reward the business improvements. This is the hidden metric I promised you, the share dilution cadence. Watch it carefully, because it is the single biggest reason the operational recovery has not yet translated into a stock price recovery. Now, none of the internal story matters in isolation, because the macro environment right now is an absolute nightmare for high beta, high leverage names like AMC. 10-year Treasury yields just hit a one-year high of 4.60%. When you can get 4.5% to 5% sitting in a bond with essentially zero risk, why would you park capital in a volatile entertainment stock? You would not, and that is exactly what institutional money is saying with its feet. Couple that with Brent crude oil surging past $109 per barrel on the back of ongoing Middle East conflict, and you have a recipe for sustained inflation anxiety. When consumers are worried about what it costs to fill their gas tank, they think twice about discretionary spending like going to the movies. This risk-off macro environment is systematically punishing leveraged assets regardless of underlying business performance. AMC is being swept up in a tide that has very little to do with how much popcorn they are selling. Could yields pull back, oil cool off, and risk appetite return in the next 60 days? It is possible, but timing that shift is something not even the smartest people in the room can predict with confidence. Now let's look at the actual chart because the price action tells its own story. This is what I call the pain chart. 12 months ago, AMC was trading at $2.95. Today, we are sitting at $1.28. That is a near vertical slide down a ski slope with almost no meaningful bounces along the way. In the last trading session alone, we saw a nearly 4.5% single-day decline. When a chart looks like this, the most important question you have to ask is, where is the bottom? And that brings us to the technicals. The current technical consensus on AMC is a strong sell. The stock is trading below its 5-day, its 50-day, and its 200-day moving averages. That alignment is the textbook definition of a sustained bearish trend. The short-term, medium-term, and long-term momentum are all pointed in the same direction, and that direction is down. The MACD, which measures the momentum of price movement, is sitting at negative 0.038. That confirms the bears are firmly in control. The average true range, our volatility gauge, is actually relatively low right now, which means the stock is essentially coiling, compressing its energy before its next significant move. But here is the thing that should make every short seller in this trade a little nervous. Look at the RSI. The relative strength index is currently at 31.7. Anything below 30 is considered technically oversold, a condition where the selling has become so extreme relative to historical norms that a mechanical bounce becomes statistically probable. We are one bad day away from crossing that threshold. The rubber band is stretched almost as far as it can go. So if the technical picture is this bearish, who in their right mind is buying this stock right now? The answer might genuinely surprise you. Discovery Capital Management just increased their AMC stake by over 41% and now controls 8% of total shares outstanding. Pentwater Capital is sitting on 63.6 million shares, right up against their 9.99% ownership ceiling, which tells you they own every share they are legally permitted to hold without triggering additional disclosure requirements. These are not retail investors chasing a meme. These are sophisticated institutional players making large, deliberate, calculated bets. And simultaneously, AMC made a meaningful balance sheet move by offloading their majority stake in Hycroft Mining, the gold and silver company they had acquired years ago. That divestiture signals management is serious about streamlining the business and refocusing on their core theatrical operation. The smart money is repositioning, and they are doing it quietly. Even with all of this information, the analyst community cannot agree on what this company is worth, and the spread between the bulls and the bears is one of the widest I have seen recently. Benchmark just upgraded AMC to a buy with a price target of $2.50. Their argument is compelling. AMC has restructured its cost base to the point where it no longer needs a record-breaking box office to reach break-even. The economics of the business have genuinely changed. On the other side, Citi maintains a sell rating with a target of just $1.20. Their concern being that the current pace of dilutive share issuance is a structural feature, not a short-term fix. One of these analysts is going to be spectacularly wrong. The gap between $1.20 and $2.50 is exactly where the real money gets made or lost in this trade. But there is a factor that could force this stock toward that $2.50 target far faster than Citi's bear case expects, and it lives in the short interest data. Over 106 million shares of AMC are currently sold short. That represents nearly 20% of the entire tradable float. The days to cover metric, which tells you how many days of average trading volume it would take for all short sellers to buy back and exit their positions, is currently at 5.68, nearly 6 full days of volume. Think about what that means. If a positive catalyst drops tomorrow, a monster opening weekend, a surprise debt refinancing, a new strategic partnership, short sellers do not just exit and disappear. They have to buy shares to close their positions. And with nearly 6 days of covering pressure stacked up, that buying can become self-reinforcing very quickly. That is not just a rally. That is a potential short squeeze, a violent, rapid repricing driven by forced covering. Could a squeeze materialize if the right catalyst hits? The probability is not zero, and the setup is clearly there. Speaking of catalysts, the options chain for the May 22nd expiration is telling a fascinating story. On the call side, over 23,000 contracts are positioned at the $2 and $3 strike prices. That is a lot of optimism baked in. But look at the put side, and you see something very interesting. A massive wall of open interest at the $1 strike. That kind of put wall creates a gravitational floor, a level the market is pricing in as a near-term downside limit. With implied volatility above 130%, the options market is telling us a large move is coming. The direction remains the question, and the calendar may provide the answer. On May 22nd, The Mandalorian and Grogu hits theaters. This is a generational franchise moment, the kind of opening weekend event that moves concession numbers materially. Beyond that, the Arena One live concert series launching in June is essentially high-margin, low-overhead revenue that drops nearly straight to the bottom line. And for the long-term investors in the room, the Netflix partnership for a Narnia theatrical release in 2027 is a signal that carries strategic weight far beyond one film. It tells you that the streaming giants have finally acknowledged what theater operators have been saying for years. The theatrical window creates the cultural event that makes a major film financially viable. The death of cinema narrative, the idea that streaming would permanently kill the movie-going experience, is looking increasingly overstated. Here is your map for the week of May 18th through the 22nd. Your immediate support level is $1.28, the current price. A clean breakdown below that opens the door to the psychological floor at $1.00. On the upside, you face immediate resistance at the Fibonacci pivot of $1.30. A move through that level targets $1.42, which aligns with the 50-day moving average. Your first real objective on a sustained breakout is $1.45, which would fill the post-earnings gap. Beyond that, the path opens toward the $2.50 analyst target. For the speculative entry trader, you are looking at the $1.27 to $1.28 support zone as your entry point, targeting a relief bounce into the May 22nd film catalyst. High risk, defined reward, tight stop. For the conservative entry trader, you want to wait for an hourly close above $1.30. Confirmation that the Fibonacci pivot has flipped from resistance to support. You sacrifice some of the initial move, but you dramatically improve the probability of a sustained trade working in your favor. Long-term, AMC has to solve two structural problems to build a permanent recovery rather than just a series of short-term bounces. First, the debt-to-equity swap cadence has to slow. Until the market sees a clear trajectory toward reduced dilution, the stock price will always have a ceiling above it. Second, watch the concession margin line every single quarter. AMC is increasingly a high-margin food and beverage business that also happens to show movies. If they can sustain per-patron spending growth while managing costs, they can generate free cash flow that makes the equity story credible even through slower box office cycles. Debt reduction and concession margins. Those are the two levers. Watch them obsessively. The short-term outlook for AMC is controlled consolidation, with the stock most likely bouncing between $1.25 and $1.35 as the market processes the Mandalorian opening weekend data. The operational reality is clear. AMC is a meaningfully stronger business today than the stock price reflects. We are in a high-risk, high-reward environment where the short interest, the option structure, the institutional repositioning, and the upcoming content calendar have created the conditions for a violent repricing event in either direction. Before we wrap, I want to be very clear about something important. Everything discussed in this video is for informational and educational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Investing in individual stocks, especially high-volatility names like AMC, carries significant risk of loss. Always do your own research, consult a qualified financial professional before making investment decisions, and never invest more than you can afford to lose. Past performance and short-term technical setups are not guarantees of future results. Now, here is what I want to know from you. Do you believe the operational improvements at AMC are real enough to eventually overcome the debt overhang and drive a sustained stock recovery? Or is this just another false dawn before the next leg lower? Drop your honest take in the comments below. I read every single one, and I genuinely want to know where this community stands. If this breakdown gave you value today, please hit the like button. It takes 2 seconds, and it makes a massive difference in helping this channel reach more investors who are trying to make sense of complex situations like this. If you are not subscribed yet, click subscribe right now so you never miss an analysis. And if you want to go the extra mile and support Smart Stock Sam directly, you can do that right here on YouTube through the Super Thanks feature. Every contribution genuinely helps this channel grow and keeps the deep dive content coming. This is not just a movie theater stock anymore. It is a battleground for the future of entertainment valuation. Stay disciplined, protect your capital, watch those levels, and I will see you in the next one.